Nobody starts their crypto journey with $1 million. Most people start with a phone, an internet connection, and a paycheck that does not stretch as far as they need it to. And the internet is full of content that will tell you to buy the right coin at the right time and watch your life change. That is not what this video is. This video is the actual system, the step-by-step framework that separates the people who build real wealth in crypto from the people who show up every bull market, make some paper gains, lose most of it in the crash, and wonder why they keep ending up back at zero. If you apply what is in this video consistently, the math works in your favor. If you skip steps, look for shortcuts, or let emotion override the system, the math works against you. That is the honest setup. Now let us get into it. Before we talk about a single investment decision, we need to talk about the foundation, because the number one reason people who start from zero never reach the life-changing numbers is not that they picked the wrong coins. It is that they never built a financial base that could survive the volatility that is guaranteed to happen along the way. Crypto is one of the most volatile asset classes in human history. We have documented drawdowns of 70, 80, even 90% in major assets across multiple cycles. If you go into this market with money you cannot afford to lose, with no emergency fund sitting outside crypto, with credit card debt charging you 20 to 25% interest, you will be forced to sell at the worst possible moment. Not because of bad luck, because of bad structure. So here is the actual first step before you buy a single dollar of crypto. Get your financial house in order. 3 to 6 months of living expenses sitting in a high-yield savings account. Untouchable, not in crypto, not in stocks, just cash that you can access in an emergency. Pay off any high-interest debt that is charging more than 10%. The reason is pure math. If your debt costs you 22% annually and your crypto investment needs to go up 22% just to break even on the debt, you're already behind before you start. Once those two things are handled, then you begin allocating to crypto, and only ever with money that you have genuinely decided you could afford to lose entirely. Because in this market, that scenario is not theoretical. Now, here is where most beginners make their first strategic mistake. They try to find the perfect entry point. They watch charts, they wait for a dip, they wait for a bigger dip. They overthink every transaction until either they miss the move entirely or they panic buy at the top because the FOMO became unbearable. There's a name for the strategy that eliminates all of that emotional noise. It's called dollar cost averaging, and the data on it is stunning. Dollar cost averaging means you commit a fixed amount of money at a fixed interval, weekly or monthly, regardless of what the price is doing. You don't look at the chart and decide whether this week is a good week to buy. You buy because it's Tuesday or because it's the first of the month. The schedule is the strategy. According to 7 years of backtesting data from 2018 through 2025, a fear-based dollar cost averaging strategy returned 1,145%, outperforming even simple buy and hold by 99 percentage points. And if that sounds abstract, consider the simplest possible version of this strategy. $10 a week into a single major crypto asset over 5 years turned $2,610 of total investment into $7,913. A 202% return, and it crushed gold, Apple stock, and the Dow Jones Industrial Average over that same period using just $10 a week. That's not a special entry point. That's not insider information. That's consistency compounding over time. The people who started a $10 weekly position in 2019 didn't know where the price was going. They just kept buying, and the market rewarded their patience. Backtesting data from DCABTC.com shows that $100 monthly positions started in January 2014 would have grown a total investment of $14,600 into nearly $1 million by early 2026, a 6,712% return over 12 years. Now, does past performance guarantee future results? No, this is not financial advice, and no one can promise you specific returns. But the principle embedded in that data, that consistency in a fundamentally strong asset class over a multi-year horizon outperforms emotional timing, is one of the most well-supported ideas in all of investing, not just in crypto, in every market that has ever existed. Step 2 is building a portfolio structure that matches your risk tolerance honestly, not the risk tolerance you think you should have, the one that will actually let you sleep at night when the market drops 50%, which it will do at least once on your journey. possibly multiple times. Here is a framework that experienced investors use as a starting point. 60 to 70% of your crypto allocation in established, large-cap assets with genuine institutional backing, real transaction volume, active developer ecosystems, and multiple years of market cycle survival. These are the anchors, the assets that are most likely to still exist and be relevant 5 years from now. 20 to 30% in mid-cap assets with clear real-world utility, documented institutional partnerships, and use cases that are already operational rather than purely theoretical. These carry more risk and more potential upside than the large caps. The remaining 10%, and this is a hard cap, in smaller, higher risk, higher conviction bets, the kind of position where if it went to zero, your overall portfolio would hurt but not collapse. Never let any single asset in this category exceed 5% of your total holdings. The critical discipline here is that the percentages are guidelines, but the principle is non-negotiable. You don't put 70% of your savings into something you heard on social media 3 days ago. Every asset you hold should have a thesis you can explain clearly to someone who has never heard of crypto. If you can't explain in 2 sentences what the asset does, who is using it, and why it would be valuable in 3 years, you have no business holding it at 10% of your portfolio, let alone more. Step 3 is the one that most people intellectually understand but emotionally fail. It's security, and it's not glamorous, which is why people skip it and then learn the most expensive lesson of their investing career. Not your keys, not your coins. That's not a slogan. It's a documented financial reality. Major crypto exchange collapses, hacks, and insolvencies have cost retail investors billions of dollars. Every single one of those losses happened to people who assumed the platform holding their assets was safe. A hardware wallet, a physical device that stores your private keys offline and away from internet-connected systems, is the difference between owning crypto and owning a promise that someone will give you crypto when you ask for it. If you're holding meaningful value in this space, a hardware wallet is not optional. It's the cost of protecting everything you have built. Enable 2-factor authentication on every exchange account you use. Use a unique, complex password for every platform. Never share your seed phrase with anyone, ever, for any reason. No legitimate company will ever ask you for it. If someone asks for it, they are stealing from you. Full stop. Step 4 is understanding the cycle, because the difference between a crypto investor who builds real wealth and one who rides the wave back down to nothing almost always comes down to one thing: the ability to take profits on the way up instead of waiting for a number that never comes. Crypto markets have operated in roughly 4-year cycles historically, anchored to Bitcoin's halving events, which cut the rate of new supply creation in half approximately every 4 years. The pattern is documented and repeatable: a bear market accumulation phase where prices are low and sentiment is deeply negative, an early recovery where prices begin rising but most retail investors are still skeptical, a bull market expansion where prices accelerate, media attention increases, and the fear and greed index climbs toward extreme greed, and then a peak followed by a correction that shocks the majority of holders who didn't have an exit framework. The exit framework is simple in theory and brutally difficult in practice because it requires you to sell assets that are going up. Here is a systematic approach that removes emotion from the decision. When any position reaches a 2 times return on your cost basis, sell 20% of that position. You have now recovered 40% of your original investment. When the same position reaches a 4 times return, sell another 30%. At a 10 times return, sell another 25%. You now hold just 25% of your original position, but you have already recovered your principal multiple times over, and the remaining stake is essentially playing with house money. You can ride that final position as long as you have conviction without the emotional weight of risking your original capital. The critical companion to this system is the signal awareness piece. There are documented warning signs that historically precede major crypto market tops. The fear and greed index staying in extreme greed territory, above 80, for multiple consecutive weeks, altcoins with no real fundamentals pumping 50 to 100% in single sessions, mainstream media running daily crypto coverage, people who have never invested in anything asking you which coin to buy, Bitcoin dominance dropping below 40% as retail
retail capital floods into low-cap speculative tokens. These are not predictions, these are patterns, and when you see multiple of them aligning simultaneously, it's time to be accelerating your profit-taking, not sitting on your hands waiting for one more percentage point. Step 5 is the wealth preservation phase that almost nobody teaches. What do you actually do with the money once you have taken profits? The answer is not to spend it, at least not immediately. The answer is to convert a significant portion into stable, interest-bearing assets outside of crypto while you wait for the next cycle. High-yield savings accounts, treasury bonds, index funds in traditional markets, diversified assets that don't move in lockstep with crypto. This is how you keep what you built. The people who became crypto millionaires in 2021 and are still millionaires today didn't hold through the entire bear market. They took meaningful profits near the top, parked capital in boring, stable assets, and redeployed that capital into crypto during the depths of the subsequent bear market when sentiment was at its lowest.
And here is the compounding reality that makes the system so powerful over time. Every cycle you execute this correctly, you are entering the next accumulation phase with more capital than you started the previous cycle with. Your dollar-cost average strategy is buying more because your position size has grown. Your risk-adjusted percentage allocation means you are holding larger positions in assets with proven track records, and your emotional stability is higher because you are not starting from zero again. You are starting from a position that was built and protected through the previous cycle. The Crypto Fear and Greed Index sat at just 8 out of 100 on April 1st of this year. That matched the fear and greed lows seen during the COVID crash of 2020. During the COVID crash, when the index hit 8 and Bitcoin traded around $4,900, the asset gained 133% over the following 6 months. During the FTX collapse in November of 2022, when the index fell to 10 with Bitcoin at $16,000, it reached $73,000 16 months later, a 350% recovery. Extreme fear in crypto markets, when measured against historical data, has been one of the most reliable signals that the accumulation phase is active, not the time to exit. Step 6 is the mindset piece, and it is not separate from the strategy. It is the strategy, because the system I just described is not complicated. Anyone reading these words right now can execute it. The reason most people do not is because of two emotions. Greed, which makes them hold through peaks waiting for more, and fear, which makes them sell through bottoms at exactly the moment they should be buying. 90% of traders who see gains of 100% or more never actually take those profits. They ride the position up, ride it back down, and either sell at a loss or become permanent holders of an asset that returned to its bear market price. The traders who build real wealth treat their portfolio like a business. They have entry criteria, they have exit criteria. They execute against those criteria regardless of what the community is saying, regardless of what social media sentiment looks like, regardless of whether the price is going up or down in any given week. The path from $0 to $1 million in crypto is not a single trade. It is not one perfect coin call. It is years of consistent accumulation during bear markets when everyone thinks crypto is dead, disciplined profit-taking during bull markets when everyone is convinced it will never stop going up, intelligent risk management that keeps you in the game through every correction, and security practices that ensure the wealth you build actually stays with you. The market does not care about your hopes. It does not know your name. It rewards those who have a system and punish those who operate on emotion. You now have the system. If this video gave you something you can actually use, hit the like button right now. It is how this reaches the person who needs this framework before the next bull market runs, not after. Subscribe if you want the full breakdown of every component of this strategy as it applies to what is actually happening in the market right now, because building wealth in crypto requires staying informed, and this channel is where we do that without the hype. Here is your comment question, and I genuinely want your honest answer. What is the hardest part of this system for you personally? Is it the patience to keep buying during a bear market? Is it actually taking profits when things are running? Or is it the security setup? Drop it below because your answer will shape the next video I make. And if you know someone who keeps asking you how to get started in crypto but hasn't taken a single concrete step yet, send them this video right now, before the next opportunity opens and they're watching from the sidelines again. Stay systematic, stay patient, do the work. This is not financial advice. Everything in this video is for educational purposes only. Always do your own research before making any investment decisions.